I want to ask you something. What does a financial system look like right before it breaks? I'm not talking about a stock market crash. I'm not talking about a bank failure. I mean the actual plumbing, the infrastructure, the mechanism that holds the entire global economy together. Yeah, we're kind of talking about some big shit here because here's the number that I can't stop thinking about today. 5.19%. That is the latest read on the US 30-year Treasury bond yield right now. That is the highest as of today it's been since July of 2007. Guess what else happened right around that time? That's right. Right before the great financial crisis. And guess what the 10-year is today? 4.69%. That is up nearly 75 basis points since the Iran war started. Most people hear those numbers and they just go, nah, not a big deal, right? To most people, it doesn't really mean anything. But if you understand as an investor what those numbers actually mean, what they're measuring, everything else starts to snap into focus. You start thinking about how that impacts your mortgage. You start thinking about how that impacts your deals as an investor. You start thinking about how that impacts stocks. You start thinking about your cost of capital. You start thinking about the global economy. And whether we are headed into a recession that nobody wants to name yet, or whether or not this is just noise, that is really what we need to unpack right here. The last time we were here at this level, the financial crisis was about to begin. That's something that we can't ignore. It's also not something I want to ring the alarm bells on, but it is something that we do need to pay attention to, and I want to unpack in today's episode. Let's dive in. What's going on, guys? Welcome into today's episode. As always, your host, Matty A. No Mr. Breedwell today. He's off gallivanting in Europe. Big shout out to Ryan. Hopefully he's having a great time with his family. One of the beautiful things, why we decide to, focus on building financial freedom, why money does matter, is because you get to leverage it in the ways that are meaningful to you. Obviously, selfishly for you, for your family, to create the memories and the experiences that, in my opinion, build a rich and amazing life. You get to make a big difference in other people's lives. And big shout out to Ryan and all the great work that he does for, obviously, myself, his clients, and many amazing Millionaire Mindcast listeners. So today, I wanted to unpack this picture that is forming, how the Iran war plays into this and really kind of triggered this, in my opinion, and why the U.S. debt situation makes it so much more dangerous. What history says about where this goes next based on some of the historical data that we can point to and look at and, unpack. And what every investor, whether you're a real estate investor, whether you're a stock investor, whether you're investing in businesses, these are some of the things that you need to be thinking about and how this weighs into the moves that you're going forward with. So let's start at the beginning, because this story is actually 5 dominoes falling in sequence. And you need to see all 5 in order for this to kind of make sense. So let's start lining these dominoes up and talk about this throughout today's episode. So domino 1, the Iran war shuts down the Strait of Hormuz. We've been talking about this for some time, right? Back in late February, the U.S. and Israel launched operations against Iran. Almost immediately, the strait, which carries roughly 20% of the world's oil supply, goes completely offline, goes dark. The International Energy Agency called it the largest supply disruption in the history of the global oil market. So that's not something that is hyperbole, right? That's not something that we can just no big deal. That is a category 5 shock to the global energy supply. And obviously, the world is feeling it right now. Now, domino 2. Commodity prices start to spike. Since the war started, crude oil is up 60%. We've seen a lot of volatility. We've talked about it on every week's episode. This has been a big reason for the volatility in the stock market and cryptos and the Treasury yields, all kinds of stuff, right? Gasoline is up 52%, jet fuel is up 58%, fertilizer is up 20%. Every one of those price increases flows directly into the cost of everything: food, shipping, construction, materials, manufacturing, you name it, right? The list goes on and on, all of it. Domino number 3. Inflation reaccelerates. We just saw the last 2 prints from the previous week. If you didn't listen to my last week's episode, we unpacked PPI prints from last week. US PPI just hit 6%, which is a 3-year high. CPI came in at 3.8%. Now, again, nothing crazy like what we saw post-COVID, but that was a whole nother era. And this still, with everything we've been working towards, is a major jump up that we have to pay attention to. This is the highest reading since 2023. We thought we had beaten inflation. The Fed thought they were getting in front of it. And guess what? What we're seeing in the latest data prints is that we haven't. And the war just relit this match. And it's something that no matter how much positive messaging and framing Trump and this administration want to say about it being transitory and that it's going to go down after this conflict resolves, which we can talk more about that and whether that's a reality in the very near future or not, it's something that has to be paid attention to because it is going back up. Domino number 4. Bond investors demand higher returns. This is something not a lot of people are talking about. When inflation runs hot, the people lending money to the US government say, if you're going to inflate away my returns, I need you to pay me more money. So what do? They sell bonds. And when bond prices fall, what happens as a result of that? Inversely, yields rise, which brings us to 5.19% on the 30-year, which we're seeing today, and 4.69% on the 10-year. Now, as a real estate investor, it breaks my heart. It does not help me with my deals. It doesn't help me with my refinances, right? This is a big reason why we are seeing a gridlock and so many challenges in the real estate industry on single family and in commercial. Domino number 5. And this is the one that most people miss. The US was already sitting. We've just continued to act like this isn't a big deal or this massive elephant in the room that is a big fucking problem. That we have heard Elon Musk say that this is unsustainable, that the Fed has been talking about this is unsustainable, that world governments have been talking about this is unsustainable. This is a massive issue that many people know, smart people know, is a problem. The US was already sitting on $39 trillion in debt and rising every single day before any of this started. Hey, what's up, guys? I'm so excited to announce if you are an investor looking to generate consistent passive income, then I've got something for you. I just launched the Imagos Income Fund. It is a private investment debt fund. So instead of relying on long-term appreciation or big exit events like most real estate syndications do, we decided to keep it simple, focused on first position asset-backed lending just like a bank, meaning your investment is backed by real collateral and structured to produce income from day one. The target return, 10% paid out annually and also paid out monthly. So no guesswork, real passive returns, true mailbox money. And because we're in the debt position, not equity, we're able to prioritize downside protection, maintain shorter durations, and stay in control of the risk, which is most important in environments like this. This is built for investors who want steady cash flow, strong capital preservation, and real asset exposure without the headaches of owning, managing, and waiting years for a payoff. So if this resonates with you, if you want to learn more, I put together a full investor presentation breaking everything down. All you got to do is just text the word income to 844-447-1555. That's income to 844-447-1555. I'll send you everything so you can see if it's a fit for your portfolio. The interest on that debt alone runs at $3 billion per day. This is exceeding the annual federal spending on Medicare or Medicaid alone. And we all know how big that was. So the budget deficit for just the first 6 months of the fiscal year in 2026, $1.2 trillion, the third worst on record. The government is flooding the bond market with new supply to fund that gap. We've got more supply, but guess what? We've got fewer buyers. Nobody wants to touch many of our bonds. And what does that do? When you got more supply with less demand, lower prices. What do lower prices mean on bonds? Higher yields. So the war poured gasoline on a fiscal fire that was already burning within the United States. And this is something that, I mean, I'd love to be optimistic. I'd love to say that we're going to figure this shit out and stay in front of it. But at the end of the day, this is something that the reality is we have to start looking at the facts and what is right in front of us. Now, can this be figured out? Can many of these variables fall back in line? Sure, absolutely. But I'm just focusing right now on what personally I think is a concern that many people should be hedging and thinking about and planning for. Now, again, in these times of crisis, obviously you want to play defense, but I also think you want to position to play offense because in times of distress, volatility, and challenges, there's also great opportunities, right? And I know a lot of people are feeling it at the gas pump. I know a lot of people are feeling it in their grocery bills. I know I'm seeing it in my construction costs on my projects. These are real things that are impacting the economics and the models of people's businesses, of people's investments, of the economy. Like this is real shit that people are having to focus on. So when I pull up my X this morning and I go to the Kobayashi letter and I look at, these 5 dominoes and where they land, we see that there's a lot of issues that need to be discussed here. We see sulfur is up 97%. We see WTI is up 60%. Like these aren't abstract things. These are things that are in your gas tank. These are things that end up in your grocery cart. These are things that end up on your construction bids. So these are real issues, right? I mean, Apollo's chief economist says rates are staying higher for longer, and quote, the traditional path to wealth creation through multiple expansion is largely closed. So, I mean, these are things that you somewhat have to listen to. Again, is this noise? Are these real signals? So let's talk about what this means for you and I, and for, let's just say, the broader economy as a whole. Because if the economy starts going in the wrong direction, that's going to trickle down to us, the smaller investors, the everyday American. So let's start with the most direct hit, mortgages. The 30-year fixed mortgage is now at 6.68%. That's up from 6% before the Iran war. And that was already feeling way too expensive for a lot of people. Now, let's keep this in the overall context of what expensive money looks like in the grand scheme of things. Like 6% is not insane. It's also not cheap compared to what many of us have been used to over the last decade or so. And Kobayashi's team believes it crosses 7% soon. I think that we're headed in that direction if there's not an Iran resolution here very, very soon. So for every $500,000 borrowed, going from 6% to 7% costs you roughly $350 more per month. That's $4,200 a year per property. Now, for buyers on the margin, which is most buyers, that's the difference between moving forward and sitting on the sidelines, especially when you see how much the average earner has not increased their wage at all. If anything, we're actually seeing many people either stay flat or go backwards. So those rates going up, that amount up per year, but you're not getting that earning power up with your wages, where does that money come from, right? That's the difference between moving forward and sitting on the sidelines. And the market knows it. So home sales remain sluggish. Prices are softening in half of the country's 50 largest metros. That's per Redfin. 2026 was supposed to be the year that the housing market rebounded, right? And instead, economists are now calling it a prolonged freeze, and we're even seeing rate hikes get baked into the futures market. 35% chance of a rate hike as of today, when how many people, I can't tell you how many people I've talked to over the last couple years going like, oh yeah, 2026, 3, 4, 5 rate cuts. I mean, Mr. Breedwell, we'll talk about this. You guys heard me on previous episodes say, I don't think we're getting a rate cut in July. He was hanging on heavy to that. Well, I think I might win that, but we'll see how that plays out. For commercial real estate, my world, the situation is even more acute. Nearly $900 billion in commercial real estate loans mature in 2026. The rates aren't going in the right direction to help those people refinance or get out of those resetting mortgages. Higher borrowing costs and tighter lender standards are forcing price adjustments. We're seeing cap rate expansions. We're seeing particularly these things are impacting the highly leveraged assets that overbought or overpaid or overestimated in their pro formas coming out of the COVID boom, where everybody thought that interest rates were going to remain low and rents were going to keep going higher and that values were going to keep inflating. And of course, we know how that's played over the last 2 years. So retail rent growth this year, 2%. Industrial, 1.5%. With inflation running near 4%, 3.8% as of the last print, that means that most commercial real estate is posting negative real rent growth. You're losing ground to inflation while your debt costs spike. That is a margin compression crisis hiding in plain sight that most people are not giving any merit to. These are real things that you got to pay attention to. Can we get ourselves out of this? Sure. Don't get me wrong, guys. I am a bull. I'm always taking a heavy dose of optimism and finding a way to spin the narrative to a positive that we're going to find a way through this. There's going to be great things that come from this. But at the end of the day, there also has to be a healthy dose of realism in what we're dealing with right now. So let's zoom out even further, because this isn't just a real estate problem. It's an economy-wide problem, in my opinion. When we see yield spike, when we see corporate borrowing costs going up, when we see auto loans getting more expensive, defaults happening, credit cards get more punishing, more defaults happening, consumer spending, which is roughly 70% of US GDP, that's the one that we need to pay attention to. If that slows, when that slows, earnings are going to drop. Stocks are going to pull back. We're at all-time highs in the stock market right now, right? This AI boom is just driving everything. And don't worry about all of the, negative data points and prints here. Let's just keep pumping, right? Which may lead to a blow off top. I don't know. We're going to see, right? Spending slow, earnings are going to drop, stocks are going to fall, 401ks are going to shrink, confidence is going to collapse. We're going to see this spiral potentially pretty quickly. Now, again, the bull case is we'll figure these things out. The bear case is this could get ugly quick. This isn't like some unwinding that would take a lot of time. Like this is the stairs are going up and the elevator is going to drop and go down pretty quickly. And this could be something that, could align with some of the bear remarks and narratives that we've been hearing for some time. I'm seeing little signs of that. Now, again, I do think that we still have plenty of catalysts that could get this sorted out. And I'm hopeful for that, because the historical parallel that haunts me here is the stagflation crisis that if you go back and look in the late 1970s and early 1980s, the 10-year yield peaked at 15.68% in October of 1981 as Paul Volcker was forced to slam on the brakes to kill entrenched inflation at the cost of a severe economic slowdown. He had to stop it. It was running away. And the only way he could do that was really hurting the economy in a really big way. And we had an initial inflation spike from the 1973 oil embargo. Any similarities of what's happening right now? I don't know. I'll let you make those assumptions. It looked contained at the time. It feels contained right now. Then a second surge crushed the economy back then. My hope is that it doesn't do it this time. We're seeing in one chart that I saw on the Kobayashi letter, They were overlaying today's CPI chart on the 1967 to 83 chart. And they're tracking each other in ways that are so similar. It is a little bit alarming. We are at the part of the chart with a major question mark as to where it goes next. We're kind of at a somewhat of a big decisive decision point. Iran conflict is still ongoing. It seemed like there was going to be a deal that got done. Seems like tensions are now escalating again and Trump's maybe going to bomb them. And I don't know. So this is where there's a lot of noise and you really have to think about your own individual situation. How much risk are you willing to take? But what I do think is happening, and I'll just give you my 2 cents on what I think is happening. And I want to share a perspective that was sent to me that I found thought-provoking. And one of the reasons I love about Ryan is he's great at cutting through a lot of the noise and bringing things back to a sense of reality and not being as chaotic as some of these data points can make things feel. At the same time, being overly optimistic can leave you overexposed. And so I do think you have to have a healthy level of paranoia in times like right now. Maybe you don't get as much of the upside as you're thinking in certain scenarios, but you definitely don't risk seeing substantial downside. And so maybe you think about how that applies to your own unique situation and how you want to position accordingly. So I'm not saying I endorse every conclusion in this, but I do think it's worth sitting with. The 10-year Treasury yield is widely considered the most important financial benchmark in the global fiat system. That's a fact. It drives valuations, it drives borrowing costs worldwide. Most people think of it as a risk-free rate, but it's more accurate to think of it as, let's call it the beating heart of the US dollar system. And when yields rise sharply, like we're seeing, it means investors are selling treasuries. And when investors sell treasuries, we're seeing the likes of China. We're seeing a lot of people who have held US treasuries for a very long time. And when they see a lot of risk, they start de-risking and selling those treasuries. That's what's happening right now. The US government, their borrowing cost begins to explode as a result of those treasuries being sold off. So here's the math that should maybe not concern you, but should get your attention. Here's the thing about most investors right now. They're consuming a ton of content, but they're not actually more informed. They're reading all the headlines, they're watching the tickers, they're following all the noise that mainstream media wants you to follow. And at the end of the day, you're still not informed on what it actually means for your deals, for your portfolio, or for your next move. So if you're listening to this right now, I don't think that's you. I think that you actually want to understand what's happening, how it impacts your investments, what you should be doing going forward, what you shouldn't be, and not just reading about it. That's why I decided to build the Wealth Intelligence Brief, a newsletter sent to you 3 times a week directly to your inbox where we cut through the noise. We send you the macro data, the real estate intel, crypto signals, and all the unfiltered takes in 5 minutes or less for free. Eliminate the noise, keep the edge. Sign up by texting the word WIB to 844-447-1555. That's WIB to 844-447-1555. At today's debt levels, every single basis point increase in the government's average borrowing costs adds roughly $3.9 billion in annual interest expense. The 10-year yield is up 63 basis points since the war started. That is nearly $250 billion in additional yearly interest costs on top of the deficit that was already there, that $1.8 trillion. So here's the trap or the challenge that I see the Fed in. We got Kevin Warsh coming in on Friday. Jerome Powell is out. We're talking regime change. There's all kinds of crazy stuff going on at the Fed, which is, of course, supposed to be independent as the head of the central bank and focusing on how to keep this machine of the U.S. economy moving in the right direction. And this is the part that I find most interesting. If rates stay high, debt service costs keep exploding. If Treasury auctions weaken and we have less buyers, policymakers are going to face pressure to intervene and figure out how to alleviate some of that pressure. And the only tool the Fed has to suppress yields is to buy treasuries with newly created money, which is what? Money printer goes, brrr. It's going to go brrr a lot louder than maybe some people would like to see it. regardless of what label they attach it to. But printing money does what? We saw this really every time they print money. What does it do? More dollars going after the same amount of goods and services, prices go up, things inflate, right? Which causes bond investors to demand higher yields, which forces more printing. You guys can see the loop. So this is the concern that I have. This is what I'm paying attention to. And this isn't hypothetical. Like the U.S. has done this many times before. During World War II, U.S. debt surged and policymakers capped Treasury yields to keep financing costs low. That peg lasted until 1951. The question being asked by some serious analysts right now is, are we headed toward a modern version of that? And if so, what does that mean for the purchasing power of every dollar you and I hold? That's really all I care about, right? Like these big fucking institutions, like it doesn't impact them. Smart money finds a way to benefit from this. Always. Government, the elite, right? Big money, smart money, they always find a way to get ahead. It's the little guys and the smaller investors and the medium-sized investors and the everyday Americans who don't even know that this is going on that get squeezed out of this. So this is where I want to be straight for you. I'm not calling a dollar collapse. No, by no means necessary. I am not a doomsday guy. But I do think this perspective deserves to be on your radar as an investor. I think it's important. It's your fiduciary over your wealth or anybody else's wealth that you're overseeing to ensure that you pay attention to this shit. Because if the Fed is forced to suppress yields through money creation, the people who get hurt the most are those holding cash and long duration fixed assets. And the people who benefit, those holding real hard income producing assets, like well-structured real estate deals. That is where I get a little bit of peace in this process. That being said, and Ray Dalio has said this for years, cash is trash in an inflationary debasement cycle. And we've been going through that process for some time. So whether you fully agree with that or not, understanding the scenario changes how you think about your portfolio mix, maybe how much cash you've got going on, where that cash is parked, what assets you're holding, whatever. The Fed is already trapped between inflation and recession. And that's the delicate dance that they're trying to balance here, right? We've got this massive juggernaut of the US economy showing that it's got strength and resilience and grit, and yet it is human. And it can't necessarily withstand all of the blows all of the time. And that's just the reality of the situation. We've seen that in past recessions and in past cycles. So at the start of 2026, markets expected 4 rate cuts. Now the odds of a rate hike are 36% as of today. Now that could change. We went from 4 cuts to they might actually hike in under 90 days. That's how quickly things can change. And that's how you as an investor, how nimble you need to be. Jamie Dimon said it plainly. We haven't had a credit recession in so long. When we have one, it will be worse than people think. We may have a credit issue going on in the underlying society of the US economy. So something to pay attention to. Again, what do we actually do right now? Well, I think there's a couple moves. I'll name 3 of them, specific ones. Move 1, I think you need to re-underwrite every deal that you're looking at right now. If you haven't bought it yet, underwrite it at higher mortgage rates immediately. If your model was built on rate cuts this year, next year, you need to change that. Model the worst case. If the deal still pencils, you're in a strong position. If it doesn't, you just saved yourself from a very expensive mistake. Now, move number 2, tilt your portfolio towards inflation-resistant assets. Short-term leases with rent escalators, multifamily that reprices monthly, self-storage. Sometimes hotels can be good for that. Industrial with short-term tenants, long-term fixed leases with credit-backed tenants. These are things that you want to identify and think of that could be some of the alpha that can help you with some of your real estate assets. Know which of your assets win and which of your assets lose if inflation stays elevated for longer than people think. Move number 3, watch the 10-year Treasury yield like it is your most important daily KPI. I mean, truly, if it breaks above 5% and holds, brace for more pain across to every asset class. And I truly mean that. If it pulls back, that's your signal that the pressure is easing. That's good. That's great. Everything else follows this number. And what you're gonna, want to be thinking about is the fact that you just have to be more intentional about stress testing all of the places that you're thinking about putting capital right now. So bottom line, bond market is telling you that something, the Fed is just not saying out loud right now. And they're trying to figure out as quickly as possible and stay in front of the mainstream media because the media isn't connecting it clearly. And most investors aren't acting on it yet. We are in a rising inflationary environment. We are in a high debt environment. We are in a war-driven environment. We're in an environment where the cost of capital is not coming down in the way that anybody modeled or thought it would. We are in an environment where there is a true risk of stagflation. These are things that you got to just be honest with yourself about. It's the conversation happening in every serious investment office right now that I get a little insight into. They're all talking about this stuff. Smart money is very in tune with this right now. So the investors who win from here aren't the ones waiting on some Fed rescue or some blue sky scenario. They're the ones who can see this clearly, and they're the ones who can position accordingly for it, right? Own real assets while everyone else holds paper that's quietly being devalued, right? Cash being one of them. And these are the seasons, though, that I'm going to just reiterate this, truly believe. I believe this for myself. I believe it for you. I believe it for anybody that is being proactive in listening, that is learning, that is networking, that is tapping in as best they can. These are the seasons that could completely change the course of your life, your family's life, your family tree for generations. And don't take that lightly. It's also a season that could completely cripple you for generations as well. So hopefully you enjoyed today's episode. I'm curious on your thoughts. Shoot me a text, 844-447-1555. If you're not subscribed to the Millionaire Mindcast, don't forget to subscribe. If you enjoyed this, if you think somebody else would enjoy it, share it with a friend, a family member, drop a comment. Are you bullish? Are you bearish on the economy right now? Are you in the camp that you think that we're going to get this all sorted out? Or do you have some concerns? I want to hear where you stand. And next episode, we're going to be diving into more of these insights and how they impact your portfolio. As always, keep investing in yourself and your wealth on your march to $1 million and beyond. Cheers, guys.